Hi, Ben Kingsley here. I just want to talk to you about what's going to be the future of mortgage lending here in Australia. Now, before we talk about the future, let's think about what's happened in the past. Now, in the past, we used to see mortgages that are like this. We had standard variable rates, and those standard variable rates were the main rates that were available in the marketplace. Now, from that, we got a product called a basic rate. And that basic rate was a discount to that variable, but it didn't have all the features and benefits that you're looking for in a fully fledged standard variable loan. So from that point in time, we saw the banks produce products called Pro Packs. So they're professional packages. And what actually happens with these Pro Packs is they offered different types of features and benefits. Now these Pro Packs started to offer discount pricing. So you got 0.7 off the standard variable rate when you bought that product. They also had things like offset accounts, etc., etc. Now, that's all good. Credit cards is another one that they used to have, as my pen starts to fail me. Anyway, so this is how it went. Now, in terms of prior to people like Aussie Home Loans and competition and mortgage brokers coming into the market, we also used to have a variance between owner-occupied or people purchasing properties and investment lending. So there used to be a slightly higher increase in the interest rate compared to what the owner-occupiers or private purchasers were paying. So that's now come back to roost because we've just seen APRA introduce higher pricing to try and slow down investment lending. Now, what's going to happen here, or what we've seen in the competition in the marketplace, is that there's been a lot of discounting happening on these Pro Packs, and the majority of clients have these types of Pro Packs. So the more you borrow, so if we were borrowing greater than $250,000, we would start to get a discount, so call it 0.7 in the old terms. Then if we borrowed greater than $500,000, we would get a bigger discount, say maybe 0.85. If we borrowed greater than 1 million, we would get a discount of 1%. Now that's what's basically happened in the past. Now all of the lenders are now doing this, and we're seeing competition in this space where, it's not uncommon to see 1.2 to 1.4% basis points off these variable rates. The more you borrow, the more they would give the discount. Now, that then says that everyone at a barbecue and all that, well, I've got a 0.8 discount, I've got a 0.9 discount. What did it all mean? Well, depending on what rate you were paying, it was a discount off that level. That everyone's now enjoying these discounts. How is that going to benefit the banks in keeping their margins at the level they want to keep their margins? Now, part of this process is going to be around, okay, how do we do that? Well, with the advent of innovation and technology and big data, the banks are now going to be more powerful in being able to price what we call personal risk profiling and pricing. Now, this personal risk profile and pricing will give the banks the ability to price based on a lot of different variables. So the complexity around what interest rate you are going to pay into the future is going to be determined by some of these things, all of these things, a combination of these, even further credit risk profiling that the banks may undertake. So more than ever, we're going to see some complexities around these types of pricing. So we're not going to see the one-size-fits-all pricing that we've seen in the past. We're actually going to see banks and lenders price in this manner. So let's work through them because it's really important. And given that it's probably going to be 18 months to 24 months before we see this pricing take shape, it's good to get your house in order now before they start doing these types of pricing. And so we're going to see things like credit scores being more and more important. Now, a credit score is the way in which you pay your credit back, the way in which you conduct yourself around that. So it talks about your overall score, your history, and also your credit activity. Now, I've used this word churn here. What churn means is if you're refinancing from one lender to another every 2-3 years, either because your broker's doing it or because you think you need to get a cheaper interest rate, well, guess what? The banks are seeing that on your credit profile, and they're saying, we don't necessarily want a customer who keeps refinancing to us, away from us, and who's so price conscious that they're not going to be a value customer that we can make our profits for our shareholders on. So the more activity around refinancing you do, potentially the higher interest rate you may pay into the future. In addition to that, they're going to look at the security. What is backing up the mortgage that they're lending against? And more detail is going to go into the postcode, location, in terms of, is that a good location? Is there lots of volatility in prices in that location, i.e. mining towns or areas that have oversupply potential, such as city locations, CBDs? What type of property are you going to buy? Student accommodation, studio apartments, low or what we would consider high risk type properties, units. So there could be pricing based on the type of property it is, as opposed to just looking at it as a residential property. In addition to that, the purpose, i.e. is it purpose built? So is it for holiday letting? Is it for overnight stays, such as serviced apartments? Is it student accommodation? What is the general purpose of that property? And again, you could see introduced higher pricing for those type of what they would consider higher risk purposes for what's going to happen in the property. Now, we've already seen loan to value ratios taking shape. The higher the loan to value ratio, we're already starting to see some pricing around those loan to value ratios, because from the bank's point of view, they package up those securities and they get their funding against those when they go to the Reserve Bank, or they go and price that book of security so they can borrow more money to lend out and keep their margins at a profitable level. So we'll see the lower loan to value ratios, potentially the better price point. And then we're going to talk about into employment. Now, this is some area, look, we've seen consistency of employment being important, but not necessarily focused in. So the industry that you work on, that you work in, I should say, any qualifications that you may have, and the level of income that you're earning, all could be combined into an algorithm that will spit out a pricing point. So again, gone are the days where mortgage brokers might be able to go to a bank and say, I've got 60 clients, can you give all these 60 clients a better deal based on the amount that they're borrowing, as opposed to based on their individual circumstances. So get ready for it. It is absolutely coming. We're already seeing it in the personal lending space, but it's going to come into mortgages. I suspect over the next 18 months to 36 months, we'll start to see more of this types of pricing. So what is that message for anyone who's looking to lend? Well, it's going to be more confusing than even the most complex mobile phone deals that are out there in the marketplace. So again, more importantly than ever, you'll need to work with a qualified property mortgage broker. They are the best of the breed. They are going to be able to sort through this. The retail pricing that you see advertised will mean nothing. These brokers will be able to identify, sort through all these thousands of different combinations to try and work out where your price point sits. So technology, innovation is going to disturb the way in which mortgages are going to be written into the future. So it's really important that you understand these. Get your house in order. Understand this stuff first. You need to make sure you're great with managing your money. You need to make sure that your conduct, your activity history, all those things are being well looked after. Otherwise, you could potentially be paying more for your mortgage rates. Okay, so it's really important. In terms of the types of properties that you're going to be buying, whether it be owner-occupier or investment, again, really important. What sort of risk levels do the banks have in regards to how much debt you're taking on? You may also see into the future that lenders won't have an appetite for lots and lots of lending with one consumer. Where you might have 1.5 million with one lender, which in the past used to give you a great discount, may not be the case into the future. I suspect the banks will want really that type of money from really qualified individuals on high incomes in professional jobs. But if it's a mum and dad, teacher and nurse, and they're trying to borrow 1.5 million to build out their property portfolio, I suspect you're going to see pricing for their household to be different than that from a professional household. Disappointing, I understand it, but at the end of the day, this is commerce. This is business, And from the bank's point of view, they want safe risk, and with that risk, they'll price it accordingly. So the higher the risk, the higher the cost it is to you as a borrower. So there's a lot of work to be done in this space. You'll see more and more of this development take shape, more and more of this starting to hit the media over the course of the next 6 to 12 months, and you'll see a progression towards this personal risk profiling and pricing in regards to how mortgages are done in Australia into the future. Thanks for watching.